Hello and welcome to SwitzerTV Investing. This is a program we put out on Mondays to actually capture some of the investment ideas that are in the heads of some of the smartest people I know in the market. And the idea is to actually help you get rich by investing in some really smart stocks. Go to our YouTube channel to see this every Monday and make sure you tell your friends and family as well. On tonight's show, Julia Lee from Berman Invest and Michael McCarthy from CMC Markets will talk about the stocks that they like and they don't like. We'll be joined by Pengana's Brian Fisher, who identifies the best stocks, the banking stocks in Europe after going there and actually examining some of the better bank stocks in America. And the Dutch are really looking like they're the best. And finally, Perennial's Damien Cottier runs a small cap fund that specialises in environmentally sound companies. This is a small cap company, and he reckons that not only are the companies actually very good, but also they actually have something very positive in an environmental sense. And I think he believes that's a really strong growing area for stocks going forward. That's the show for tonight. So without any further ado, let's go and talk to Michael McCarthy and Julia Lee. Thanks for joining us, guys.
Pleasure.
You want to boast about your Eclipse tip?
I've got a few, but I know Eclipse is doing really well. I still like it, but I think when we talked about it, it was around about the $1.20 mark and sort of getting closer to that $1.80 mark, which is nice to see.
So if you are late to join us this great show, you missed that tip, or if you heard it and didn't take the tip, well, we're really sorry for you, but that's what this show's about. People like her making you rich by actually listening and doing it. Mike, how about you? Anything you want to boast about?
No, absolutely not, Peter. I've learned over the years, as soon as I start boasting, the market will kick me in the teeth. So
I'm scared now.
I'd be careful.
Be
careful.
For the doctor.
That's right.
Okay. All right. So this time I've actually given some directions about what I want to do. The stock of the week for you, Julie, which one do you like?
Well, given that Eclipse has been doing so well, I thought I'd choose one in the same vein, which is Smart Group. And the great thing about reporting season is you get a view into which companies are doing well. Smart Group's in the novated leasing as well as salary packaging space as well. But I guess having a look at Smart Group, it was fascinating to see the result. It was resilient in the face of, what we have seen to be a pretty tough consumer environment. So look, I think Smart Group is going to continue to do well. I think it's probably taking market share at the moment, and I suspect that we're going to see some more upgrades coming through from this company.
Did they explain why?
Sorry,
but did they explain why they were doing so much better in, as you say, a troubled environment for consumers?
Well, I guess the novated leasing area was doing quite well, which is surprising given the trends that we've seen in new car sales over the last couple of years. So, look, I think it's a business that has very strong cash flow, and that means, of course, capital management, which is lovely to see when you have that very low interest rate environment. So, look, I think Smart Group's looking pretty good.
Mackie, you review on Smart Group?
I like the ticker code, SIQ. Got to give them a tick for that one. It's a difficult space, but there is an ongoing trend towards outsourcing of corporate functions and their beneficiaries. They appear to have a second generation jump on their competitors, and they've come into this later and are able to build systems with the knowledge that's already been established in the space. I tend to agree. I think they'll be an outperformer.
Okay. Now, what do you like?
I like A2 Milk. Now, everybody wants to buy these stocks when they're trading at $17, but when they pull back to $12.40, people are less inclined. And there is an argument going on at the moment. Its most recent result, A2 Milk told the world it's going to be reinvesting in its business, and in particular, its China sales. And to me, that makes sense, but it does have an impact on margins. Operating margin falls from around 31% to about 28%. Now, that means analyst valuations come down. But for me, this is investing for the longer term growth of the stock. And given the spectacular job management have done so far, I tend to back them, Peter. And I think the current 20% plus pullback in the share price is an opportunity for those investors who haven't got on board.
So when everyone is fearful, be greedy.
Fill your boots.
Okay, right. You heard from both Warren Buffett and the Oracle of Manly.
Never been called that before.
I know. You'll be able to see his team got clobbered on the weekend. Not clobbered, just beaten, I guess, if anything to say. All right. What about, I asked you guys to think about Link. And Link is a company that was particularly clobbered because of Brexit and a few other reasons. And I'm looking at Link from a point of view of, if Brexit gets out of the way, does the major challenge for this company get out of the way, and therefore it's a long-term investment as opposed to an immediate one. Now, you always seem to me like a now girl. You want to make money fast and soon. But I want you to think about it from a point of view for our viewers who might be long-term investors. Is this a company that has upside once Brexit gets out of the way?
Look, I like this one for buying now. I think that the current financial year will still present challenges, but I think this is a company that's looking at double-digit earnings growth in outer years. So look, usually you want to move before that happens on signs of weakness, and certainly it's going through a patch of weakness. We have seen a bit of recovery in terms of the share price, but they're also undergoing a cost-cutting program over the next few years, which should start to see results as well. So look, they have had a few challenges, and they probably will continue to have some challenges in the current financial year. But I think in 2 or 3 years' time, this is a company that's going to be seeing double-digit growth.
Okay.
No, not for me, Peter. And although I do think it will bounce once the Brexit situation is resolved, this is not the way to play it from my point of view. And the reason for that is it's not just the external environment that's hurt Link. The integration of a lot of the acquisitions they've done, and in particular the UK acquisition, has been bumpy. And that's an operational issue, Peter. And to my mind, the company hasn't done enough to say, we will be able to solve this. And I'm a little concerned they're embarking on cost cutting when I don't think they've got their ducks in a row when it comes to the operation. So I'm concerned. If I wanted to play a Brexit or post-Brexit play, I prefer Clydesdale Bank.
Okay. But by the way, Julie, I totally agree with you and totally disagree with him. I wrote a Switzer report. Well, actually, for the first
Buyers
time,
and sellers.
for the first time ever, I employed a Buffett test on LNQ Link, and it doesn't get completely all the things. I think the management's good. I like the management, but an ROE was, I think, 14.5, and it probably should be 15 plus, but they didn't miss by much.
Look, I think the other interesting thing about Link is that it's undergoing a share buyback. I said it's going to buy back 10% of its shares. And to me, that sends a strong signal that the company itself thinks its shares are undervalued. And buying back those shares is also going to help boost earnings per share growth over the next few years.
Okay, so let's hope you're right. You're wrong, Macca, for
I
a change.
disagree.
Nothing wrong with that.
Okay, all right, so let's go to Blackmores. This is another company. When I got down to 68, I thought this has to be a buy. It's gone up to 80 or something. What do you guys think about Blackmores?
No from me.
Yeah.
I guess...
Was the bounce linked to Bellamy's, do you think?
I think it was the possibility that we could see corporate actions there, but the vitamin space still remains tough. And what we know from A2 Milk, Bellamy's, as well as some of the trends that we've seen in the industry, is that these items which used to be popular in China through the daigous, they're moving towards a different channel, and that's the e-commerce channel. And that's why SAMR approval is more important than ever. We have a look at H&H's recent results, which own Swiss as well as a number of other brands. You can see the trends that are happening there. And the great thing about, I guess, Swiss as a brand is that it's spending a lot of money on marketing. It is a very strong competitor, but it also has 3 SAMR approvals compared to Blackmores' 0 SAMR approvals, and that's the approval to sell directly into China. And that means that Swiss's product is stocked in over 18,000 stores over in China, whereas Blackmores
Why
is still
hasn't Blackmores
relying.
got that?
Well, it's the same case as Bellamy's. Why didn't Bellamy's get that? And I guess it's a matter of timing, the application process.
Which makes it look like a takeover target to me. Am I going? There could be some method in that madness, because like Bellamy's copped so many regularly kicks in the butt until a Chinese company wanted to buy them. Gee, work that one out.
and that might be the way they open up the channel into China, is by partnering with somebody on the ground or somebody based in China. So that's not impossible. They can't rule out corporate action on it. I think too, there are a lot of retail and consumer trends I don't understand personally. Vitamins is one of them. But the reality is they have built and grown a significant market here. And while that continues to be the case, I think there is potential. I don't think Blackmores has the same black mark against its name in China as Bellamy's did. It hasn't tried to buy its way through the back door. It's always faced China, and so I suspect an SAMR approval is easier for Blackmores. But yeah, I can't rule out that, particularly with the Aussie below 68 US cents and the yuan up around 7 against the US dollar, it's got to look attractive to somebody in China.
So, but do you like Blackmores at these levels?
Yes.
Yes.
I've tried to buy
these guys aren't
companies.
agreeing today. I love this.
I've tried to buy companies on the possibility of takeover before, and it can be a very, very long wait until anything ever eventuates, if not. So I think the key for trying to target companies with takeover is still be happy with the underlying business model, just in case it doesn't happen.
Okay, Premier Investments. Now, I'm currently filling in for Ross Greenwood with Alan Jones, and Alan Jones said, is there any retailer better than Solly Blue? I had to say, well, yeah, Jerry Harvey might think he is. And Alan kind of agrees, and yes, he might too as well. But Premier Investment has really surprised everyone. It's kept doing well. Can it keep on doing well? Julia?
Yeah, I think so. I think the thing that surprised me about the results was that it was its core brand and the clothing part of it, Peter Alexander, which really helped support the results. And in fact, we saw Smiggles growth really starting to moderate out. So that was quite unusual because Smiggles has been the driver of growth. So look, that's probably quite a positive sign for a number of retailers out there, given that clothing has been such a tough business to be in. So look, given those type of trends, I think we are seeing a strong rebound, not only on the basis of the results did beat expectations, but perhaps we could see a bit more of a revival in some of those core brands.
7% plus growth in retail.
Wow.
That is a stunning result. Now, admittedly, the Australian operation was the disappointing aspect of it this time around, and sales growth here was sluggish. The company saying it's yet to see the benefit of the tax cuts and the tax stimulus. But I think this just goes to show how a targeted and tightly disciplined retail approach can work. And that's what's happening here. You've got premier brands selectively targeting key markets, and they're doing a magnificent job. It's an extraordinary result given where consumers are globally and locally, and there's no reason to think that they can't keep delivering it. And although Smiggles growth slowed, they're looking for 14% growth with the Asian expansion next year.
I wonder whether Mark McGuinness could have done the same with David Jones. Because he left David Jones and he went to Premier, and they haven't looked back since he's been there. That's the question for Mark to answer, I guess. And finally, IOOF. Now, this is a company that was pilloried in the Royal Commission. Share price was clobbered. Did any of you tip to your clients to get into IOOF at its low?
No, but it is a dangerous thing, I think, getting into a company like this at its lows. When you do get into a company like this, it's because you can see the light at the end of the tunnel. And look, the court case win did a lot to, I guess, reignite a bit of confidence that the company's on its path to rebuilding its brand. I think the key is going to be that ANZ acquisition of the One Path Wealth business, and I see a couple of possible scenarios there. One, the deal doesn't go through and you see an on-market share buyback, so that could be a positive for investors and that could boost the share price. And the other scenario is that they might be able to renegotiate the terms, which I think would also be a positive for IOOF. I think on the con side, one of the things you have to watch for is that I think we're still going to see extra remediation costs come through. They are remediating now up to 7 years, but some of its competitors are remediating 10 years and also for past advisors, not just the current bunch.
Tough one still, Peter, and a lot of hurdles to jump over. It's not on my radar at this stage. They need to bed down a number of issues, not least of which is the new management team that's come in to replace the departing team. And of course, this ANZ is a potentially company, ANZ transaction is potentially company transforming. So no at the moment. Let's see how they go over the next month.
As Buffett said, if you don't understand it, you don't invest in it. And I just cannot. But I guess the interesting question, the final one is, does this indicate that maybe AMP has more potential than we think? The fact that IOOF can get this kind of rebound.
Look, I think the capital raising that it did was certainly a step in the right direction because, of course, a strategy change of direction costs money. So AMP has the money to do that now. I think it's a tougher road to rebuilding trust that AMP has compared to IOOF. And there are some major changes that it's making. It's a case of waiting to see whether those green shoots come through, especially given the number of advisors it's culled from its network.
Depends what investors are expecting from AMP, Peter. If they're expecting it to return to its former position as the number one wealth manager in Australia, I think that's completely unrealistic.
That is like a $5 share price and a decent dividend. That's what my people want.
Well,
how long is that? How far away is that?
That's potentially achievable, but there's a lot of work to be done, and there are a lot of big problems, not least of which is the brand damage that's been done over the last few years. So I suspect that the AMP in 5 years' time will be a very different looking creature, potentially with a different name, and it might be in different parts of the country as well. So a long way to go. It does, although this deal does point to the idea that there could be some value locked up there. And given that they're now well into the remediation efforts and they've explored a fair bit of this space, if there aren't surprises, there could well be a value proposition around AMP at current prices.
Okay. Thanks for joining us, guys. As always, very insightful. Coming up, Charlie Aiken talking about the company in his fund that he likes the most. I'm now going to be talking to Charlie Aiken, the founder of Aiken Investment Management, a fund. Yes. Charlie, a fund manager. Your daughter thinks you're a fund manager and you manage fund.
Well, some days are more fun than others, but it's a never-ending game, Pete.
Yeah. Well, one thing you said to us last time I talked to you was you were looking at Goodman Group as a possible acquisition. Have you changed your mind? Have you actually moved on Goodman?
No, I think it's interesting. I'm still looking at Goodman. It's had a bit of a bounce since the index.
Since you wrote about it.
Well, since I wrote about it. Index D weight on Friday, 95 million shares traded on Friday.
Okay.
But look, we do quite a lot of work before we'll buy a stock. I think I will often point out to you and our readers, your readers, things that we're interested in, and whether we pull the trigger or not. That takes a little bit of work. But I mean, it's quite hard in Australia. There is not much margin of safety in anything. And I see some
the good stocks have been well bought.
The good stocks are generally very well priced. As you'd expect with interest rates so low and everything else. But if you see something like a Goodman Group that's being thrown out of an index and it's a good stock and there's sort of passive selling, well, that does interest me. So that and Ramsay Healthcare the other day, where Paul Ramsay's foundation sold down, there might have been an opportunity in that. But there's not much in Australia that has that real margin of safety where you want to commit new money. I think it's my view.
Why was Goodman taken out of the index?
I think it's because it's more of a integrated real estate company than a real estate investment trust nowadays.
Okay.
It was a real estate investment trust-based index. So it does everything. It develops, it operates, it has funds management businesses. It's it's a bit more like Lendlease now, Goodman Group, than a traditional REIT. But I mean, that's an opportunity. It's a good business. It was $16 not long ago, traded down to $13.30 in this process. I think that's an interesting stock.
Has there been any new additions to your fund?
Nothing dramatic. No, we're not. We're really just
You're
holding.
doing nothing, just sitting there.
We're not getting paid to do nothing.
This guy.
You know what? It's part of looking after money. And the brokers don't want to hear this, but some days, some weeks, some months, you do nothing. You're happy with the portfolio. Yeah. We think we've got a really good portfolio at the moment of sort of structural growth stocks. We're sitting there grinding it out. There's no real need to do much. Okay. There's not this, the markets have had a bit of a bounce, and here we are.
But these people out there watching this want to get an idea of a stock they should buy. So I'm going to reframe the question. If you go through your group of stocks that you're holding, which one do you think has the most potential upside? And I'm not saying you're going to be right, but it's like if I'm a stable of horses, I know which one's got more chance to win the Cox Plate than maybe a race at Newcastle.
I still think the strongest investment case in our portfolio is Microsoft. Announced a bump up in its quarterly dividend last week, a $40 billion on-market buyback. That's 4% of the company. Seems to be travelling very well, 15% earnings growth, hardly even moved in the last month or so, that stock price. Result coming up in a month or so for the quarter, I think it'll be strong again. I think if you look at all the other stocks in the world, there's a little bit of regulatory risk in some of tech, in the Facebooks and Googles, and you can see that a little bit.
What about trade deal in Microsoft? How's it affected?
No, I don't think it'd make any difference at all, other than it's a big part of US indices, and US indices would go up on that, probably go up the same amount as the market. Look, the trade deal, I mean, we're up to the 13th round of negotiations, Pete, and I don't think they've got anywhere. Yeah. I don't think there's a trade deal coming. I think this is going to drag on and on and on. There might be some superficial handshake thing sometime before the election. And you can see even today, Chinese mainland markets didn't think there was any thawing of the trade deal. They're down 1.5% today. The onshore renminbi's up, and I don't think that's going away in a hurry.
But is this like insider trading that's some smarties have a closer connection to the trade negotiators in China or in Washington? Not really. It's just
I think whatever comes into President Trump's head in the morning really is where we are on trade.
Yeah. I don't. Hang on, Donald Trump is a very close friend of Scott Morrison.
As that right now, that's good. No, that's well, you know what? You're better off having him as friends as not, I think. So.
But I guess that the bottom line is this: if there's no trade war escalation, but just what happens is what was scheduled to happen, is the market going to cope with it, or is there something that might actually bring the market down? Because if the market goes down, that ain't going to be good for you.
I think the recovery in the last month or so has been about a de-escalation to a degree of the trade war, which is now priced in. Everyone's looking forward to this October meeting, which I personally think nothing will be achieved and the market may come back a little bit. Bond markets have been all over the place. They're now going down again in yield, which is another slightly concerning sign. You've had profit warnings from FedEx and a lot of steel manufacturers, and even the railroad companies in America are seeing lower freight volumes. I mean, the cyclical side of the US economy outside of the consumer is not doing brilliantly. They're still stuck in this, I can't commit to investing in my business because I don't really know what the trade rules are. So the CapEx side of the economy is very slow there. So it's a real mixed bag. When you see FedEx have a profit warning, it does tell you something. So I think we need probably need a trade deal to justify where we are, not where we're going.
Oh, yeah.
So
I think the market's saying we believe a trade deal will happen, but a lot of people like Citi, I think, saying 60%, it's not going to happen.
I'd say the interest rate markets are not saying that at all, but the equity market is. So we've got one of those slightly dangerous situations where the equity market's a bit more optimistic than the bond market, maybe too pessimistic, but maybe the truth lies in between. But there's been some really big movements inside the equity market. What is going on, Pete, in America, which may come to Australia, and I think people should be aware of, is a lot of these tech companies that have no profits, these profitless companies like Lyft or Uber or Zillow or Grubhub or Spotify, they've really started to fall. And WeWork couldn't get its IPO away, another profitless big tech company that's been valued in the private markets at a crazy multiple and can't get away in the public market.
So what is that telling you?
Well, I think it's telling you to be cautious on the Afterpays and WiseTechs in Australia and the WAX stocks. I really think it is. Now, they're still the flavour of the month, but there is no margin of safety in those stocks. Afterpay this afternoon has got a market cap of 8 billion, and I think WiseTech's 11.6 billion. Those two combined are bigger than Coles. I mean, really? I think it's time to be cautious on profitless tech stocks. That's all I will say. The ones with profits, like Microsoft and great cash balances, and Apple are doing just nicely. But I think the American market's telling you the equity market's getting a bit tired of these huge valuations with no profits. So I think that's just something to be a little bit cautious on.
Okay, before I let you go, is there one stock you'd like to talk about that might excite my viewers?
Well, I think, look, we're in the middle of nowhere at the moment.
Is there a nowhere stock?
Well, at the moment, this is a good piece of advice. You don't have to do something every day. You can just be happy with your portfolio, keep a bit of cash, and just wait for that margin of safety in a great company at a good price. Okay. And I think where everything is at the moment, I'm just happy to have a little bit of cash and just wait for those moments, Pete. Because look at the last 2 months. It was the end of the world a month and a half ago. Everyone thought the world was ending, US recession. Here we are, not so much US recession. I think we're going to be in these sort of schizophrenic markets to sort of waver along for a while, and you'll get a chance to buy good companies at the right price. And I think it is in Australia. Perhaps it's something like a Goodman Group, a Ramsay Healthcare. And the other thing I'm having a look at is actually Woodside, which has come back a fair way.
Why?
Just cheap LNG producer, 5% yield, 15 times earnings, good growth coming next year. Might be an interesting stock. So there's always something out there, but I just think people need to be patient because this is going to remain volatile, is my view, Pete.
That's Charlie Aiken, Aiken Investment Management. Ryan, thanks for joining us.
Thank you. It's good to be here.
Now, let's just start in an area where a lot of people are worried. You've got the Trump trade war, you've got Brexit, you've got EU problems, question marks over Italy and all those sorts of things. Given all these challenges, what's your feeling about being exposed to stock markets right now?
Yeah, it's a very good question. There's no doubt that the macro and political and geopolitical risks have risen compared to, say, a year ago. And not just the level of risk, but also the number of risks. You've highlighted most of the important ones. I think the important thing is that at Pengana International Equities, we're very focused on finding good companies and good companies at good valuations. We're very aware of the macro backdrop. We definitely take it into account. But we think that if you look below, certainly there are some stocks, the tech behemoths in the US would be a great example, where they've had incredibly good runs. In terms of what they've been doing as well as how the stocks have been performing, they're incredibly well owned, incredibly well loved. And so it's certainly a valid discussion as to whether they're reaching risky territory, whether they can go any further, etc. But we think if you look away from those very high focus areas, there's actually a wide range of industries and companies, many of which have been neglected, some of which are actually at really good valuations because they've been not that interesting, not that sexy compared to where the focus has been. And so that's really what we're trying to do, is we try and look as broadly as we can, have as many meetings as we can, travel as much as we can. And we think that while macro risk is high, there are still really good opportunities under the surface.
Okay.
And so as long as we really cognizant of risk reward, stay away from the riskiest areas, stay away from overvalued areas, and look for quality at the right price, we still think that there's a very good argument to be made for equities.
Okay, so you went into an area that's critically important to all stock markets, and that is banks, and in particular focus was European banks. Yes. And we have seen stories around, there are often stress tests on the European banking system. We've even seen Deutsche Bank in a lot more trouble than we would have ever guessed, say 10 or 15 years ago. So, so from my point of view, your analysis of the state of European banks is a really important one. So what is the general feeling about banks in Europe?
Yes, so again, what you've outlined is very valid, and that is an extremely interesting backdrop. And European banks have been nothing if not interesting for the last many years. Yeah. So the US banks have had a much cleaner period post the GFC. So obviously, like all global banks, they struggled in a very big way, but then they came back gradually, picked up steam, and actually have had a pretty good last few years, up until very recently. Trade wars, recession fears in the US have slowed them down. Yeah. Whereas the European banks took a lot longer to come out of their GFC problems, partly because they had to raise a lot of capital. Yep. And companies tend to be a bit slow in acknowledging the need for more capital. So that took a while. And then with the Europe being a little bit more stop-start, the banks have been even more stop-start. So they had a good run a few years ago. We actually owned the banks a few years ago, but we've been out of them for the last little while, which has turned out to be a good thing because they've been under enormous pressure. And
of course, to interrupt you, but when I was listening to you, I remember the question marks over European banks because of Brexit. The Greeks, we didn't know what the Greeks were going to do and all that sort of stuff. So there were a number of curveballs, and of course Spain and their problems with real estate and Ireland as well. So it's been a really tricky area, hasn't it?
It certainly has. And as you're alluding to there, the fact that there are different countries within the Eurozone and the ECB is trying to manage the regulation of all of those banks. And they're all subject to similar interest rates, the same currency regime, for quite different local economies and challenges. Has made things interesting. So, and that's part of why things stalled, is people, I think around the time that Macron came into power, there was a lot of optimism around France and therefore Europe. And at that point in time, I think people thought that rates perhaps were going up in Europe. And the banks actually had the best run they've had since the GFC. And we felt that perhaps that optimism was a little bit overbaked, a little bit too much too soon. Yeah. And
wishful thinking.
Yeah, I think so. Perhaps, targeting the right end game, but too quickly. As it turns out, things have actually got worse since then, largely for global reasons, rather than for Euro-specific reasons. We've had the slowdown in global growth coming through, and that's seen the expectation go from rising interest rates to falling interest rates. And interest rates are so significant for bank profitability. But to go back a step to your question about Deutsche Bank and stability and all of those things, I think it's really important for us to recognise that the problem the European banks have been having, and I think the problem that they probably will continue to have for at least another couple of years, is about profitability. They've had their profits squeezed. We can talk a little bit later on about exactly why. And they really are struggling to meet their cost of capital. There's a very small number of European banks that are handily beating cost of capital. Whereas, for example, in Australia, we're so accustomed to our banks having good double-digit ROEs. It's just a matter of how much they're beating cost of capital. In Europe, most of them aren't even getting close. However, that's very different from a question of stability. And in large part, the European banks are actually in pretty good health. So their profit and loss statements, their return on equity is getting squeezed, particularly by negative interest rates. But their balance sheets are in pretty good shape. And the reason for that is after belatedly recognising the need to raise capital, they've rebuilt the capital levels in their balance sheets. That's been helped by a regulator that's been very strict all around the world, but particularly in Europe after the experience they had, very strict in raising the capital requirements, and the banks are following. There's been a big focus on liquidity standards, a big focus on the banks getting bad debts off their balance sheets, where some countries like Spain and Italy built up enormous levels of legacy bad debts that they've now managed to get down to much more reasonable levels. And so all in all, I'd say the vast majority of the banks and the system as a whole is actually in a healthier balance sheet state than we've probably ever seen, but really struggling to make good returns on those balance sheets.
All right, so you talked about negative interest rates, and clearly the ECB is prepared to accept these because they want to get growth happening in Europe, and growth will help the profitability of banks as well, because interest rates could start creeping into positive territory. So what is the scenario, do you think, going forward? Are we going to see growth creeping into Europe over the next year or two?
I think what our work is showing, and I think there are a number of influential economists out there that I think would agree with this, is that monetary policy is probably reaching the limits of what it can achieve. Even with low interest rates in the US, people are questioning that. The Fed itself is questioning that. But certainly in Europe, where you're in negative territory, you already have negative rates, and the recent move by the ECB was to make the negative rate more negative. There are questions as to whether you're now pushing on a string, to use that phrase. And I think there's a growing school of thought that these ever lower interest rates are perhaps just stopping economies from getting worse, maybe defraying some of the pressure that's coming from trade wars, etc., but not necessarily enough to boost growth. I suppose one way of looking at that is to say, if you're a company that wasn't raising funds when you were paying negative interest rate plus only a small spread, so maybe you were paying less than 2%, if you're a strong investment grade company. If the rate goes down by 0.1 or 0.2%, does that really change your investment decision? Does that mean that you're going to build that new factory or invest more in capacity? And the answer is probably not. That's much more an issue of clarity of the outlook rather than a little bit on the lending rate. So therefore, I think that what Draghi made clear at the recent ECB meeting, and what his successor Lagarde has been saying, we think is very smart and very sensible, which is that the time has come for fiscal policy to start to pick up some of the slack.
Tax cuts and government spending.
Exactly, Monetary's done about as much as monetary can do. And interestingly, we've seen Germany do very early signs of some fiscal stimulus. We know that Germany is quite resistant to running deficits or to putting too much pressure on their budget situation. But we've seen some very early signs. We saw the Netherlands in their recent budget, I think just last week, introduce a little bit more fiscal stimulus. So that, to our minds, would be the key to getting growth back, not lower rates.
And that should help raise interest rates as well.
Eventually, yes.
Okay, let's go. You've toured a number of banks in Europe and whatever. Which one impressed you?
So I would say the short answer to that is that we think that the Netherlands banks, and to a lesser extent the French banks, came away, from the meeting, very many meetings we did, came away looking better than the others. And that's within a really tough backdrop. So I'd say the overall backdrop is really tough. And the reason for that is really about lower rates. It's about the fact that as interest rates get lower and lower, banks take a squeeze on what we call their net interest margin and their net interest income, which means that the amount they're able to charge for lending keeps on coming down. But the amount that they've got to pay to their deposits has hit a floor at zero. Rates are already through that. So effectively, every time someone's giving a bank a deposit, the bank's actually losing money on that deposit, which is an amazing situation. So it's reached the point where one of the biggest questions banks get asked in Europe is there a point where you can actually pay negative interest to your depositors? And if they could, obviously they would help them a lot.
It's called charging, charging for money.
And the answer is, I think, the sensible banks, and in fact, almost all of the banks I met with said the answer to that is no. And the reason is it's not the right thing to do to retail customers who don't have recourse to global markets the way that professionals may, to actually trade the other side of that negative interest rate, if you like. But the other reason is for PR. Who would want to be the first mover to do something like that? So what the banks are doing is some of their big corporate customers are getting passed on negative rates. Even at the private banks, some of those customers, if they've got more than, say, large amounts, we're talking more than, say, €500,000 in their deposit, they're getting charged a negative rate to encourage them to invest it instead of leave it sitting there. But there's not much more than that you can do. And the other thing these banks have is they have huge investment portfolios of sovereign securities not that much in corporates, a lot of sovereigns. And these are maybe have an average 5-year duration. And as these portfolios are maturing, they're maturing with much higher yields and having to be invested at almost zero. So that's putting a huge squeeze on their profit margin. So what you need to look for is which markets actually have good enough structure that the banks can react by actually raising their prices to offset a little bit of this pressure.
So on that subject then, you mentioned the Dutch banks, and I was always thinking that ING was probably doing well. Was that one of the star performers on your analysis?
It was. I came away feeling most comfortable with both ING and ABN AMRO, which are two good quality Dutch banks.
So ABN AMRO has made a comeback since GFC.
It certainly has, yeah.
It was a great bank for the GFC, wasn't it?
And it made just about every mistake that it could have made in the lead up to the GFC, had a huge unwind into partial government ownership, massive cleanup. And in fact, it's one of those classic situations where the problems were so intense that the cleanup was huge, and they've actually gone from the point of being a very diverse and risky bank to actually being one of the most, if you like, almost boring stories. Very narrow range of businesses, very narrow range of geographies, limited their ambition, trying to do what they do well. Whereas ING, of course, is much more of a global bank with a very different business model, a very big focus on digital. So two, although they're both based in the Netherlands, quite different stories, but both pretty well placed. Not by any means immune to the low interest rates or negative interest rates, but doing a good job. And part of the reason for that is the Dutch market has got very good structure, relatively small number of players, and they're actually able to use their prices to take some of the pressure off their profitability. Whereas, for example, I spent quite some time in Spain, a market that's consolidated but still has way too many banks and not enough business. So in that market, the banks are actually chasing more business because the spreads are low, which of course makes the problem even worse.
So given your analysis, these kind of recommendations that you've been talking about, ING and ABN AMRO, are they likely to end up in Pengana funds, and what Pengana funds should we be looking at?
Well, to take the second part of your question first is we have one investment team that looks after all of Pengana's international equities funds, but in particular we'll be looking at the listed investment company PIA and the unit trust Pengana International Equities Fund. And those two funds, we're not in a race to add the European banks. I think that was one of the main points that I came back from Europe with, is that we're probably nearing the end of the pain. The valuations have been smashed. People have woken up to the profit problems that these banks have. So I think we're near the bottom. And I think that there are some banks like the ones I mentioned that we're getting very close on. And so I think there's a good chance we'll be taking a great interest, but I don't think I think it also depends a lot on your desire for dividend yields. We know that Australian investors and Australian banks have been very generous dividend yields for retail investors. In Europe, the banks are actually up to 6, 7, 8% dividend yields because the market is so worried about their ability to grow profits. So that's one of the.
So both ING and ABN AMRO are pretty good dividend payers.
They are.
Okay, so I guess the final question then basically is this: if someone was a super cautious investor, would you be waiting to see an outcome for Brexit and an outcome for the Trump trade war before you move into those banks?
I think the answer there is, I'm always wary of saying wait for this, wait for that, because there's always something.
Yes, true.
I think that the answer to that is, I think we'd look for a little bit more clarity on trade. Because what's going on with trade is having a huge bearing on Germany's growth and therefore Europe's growth, and that's having a very big bearing on interest rates. And what we've found is that within the European banks, there are certainly some that are much better placed than others, but the sector as a whole is incredibly highly correlated to what the German 10-year bond is doing. The correlation is actually almost unbelievable how strong it's been. And so it's very hard to depart from that. And so I think that would be the case. But at the same time, we've found companies within Europe, for example, within Italy, we've recently purchased a company called Brembo, an Italian, one of the global leaders in brake components for automobiles. So we've found that's a case, similar to European banks, a sector that's been unloved because global auto sales have been under pressure. Europe as a whole has been unloved. And what we find is that people often can miss out on what we'd call sort of quality stealth growth companies and confuse them with value stocks and ignore them, let them get to prices that become way too attractive, we think.
And that's Brembo.
Brembo is, for example,
Brembo. Okay.
It's listed in Italy. It's got 20% global share of brake components around the world, from regular to very, very high-end, including Formula One vehicles, Ferraris, etc. And the things we like about it is, the fact that the quality and the growth prospects are not at all reflected in this valuation where people have lost focus. But also, even within the automobile world, you've got the situation where they're not that affected, as many autos are, by things like what's going to happen with electric vehicles, what's going to happen with autonomous cars, because unless those vehicles fly, they're still going to need a brake.
Yeah.
And as long as they need a brake, one of the leaders in brakes is still going to have a good business.
Ryan, thanks for joining us.
Pleasure, thank you.
That's Ryan Fisher from Pengana.
Okay.
Well done, mate. Damien, thanks for joining us.
Thanks very much, Peter, for having me. It's great to be here.
Yeah, great talking to an ex-student as well.
Yeah, I was just recalling, it's been a little while. But
It's been a little while. Anyway, it's
one
good
of the more memorable tutors I had at uni. So,
well, it's good to see that you actually scale the heights of greatness because of me and because of you. All right, that's enough of that. Tell us what fund that you are portfolio manager for.
Yeah, I'm portfolio manager for the eInvest Future Impact Small Caps Fund.
Okay.
Yeah, it's an active ETF listed on the ASX. The code's IMPQ.
Okay, great. So tell us what the investment theme is.
Well, what we're trying to do is really find companies which are making a positive contribution to a sustainable future. And we want to do that in a way that generates good returns for our investors. So we want to make a true to label ESG fund, so you don't have to worry about what's in the fund if you're looking for an ESG friendly, sustainable fund. And we want to do that in a way that generates good returns.
Okay, so we have some normal people watching this interview. So ESG, you should explain that.
Okay, so ESG is environmental, social and governance principles. They've become increasingly important for companies globally in the last few years. More and more investors are looking to invest in companies that are doing good things in relation to environmental, social and governance aspects. And we're looking for companies that are more than just ticking the boxes on ESG, but are really looking to do positive things and improve ESG and sustainability outcomes for future generations.
Okay, now a few years back I wrote a fantastic book called The Carbon Crunch, but unfortunately the Prime Minister of the time, Kevin Rudd, sort of U-turned on his commitment to a lot of that stuff, so the book didn't actually, we didn't even release it. But one of the points I made in the book was not only is this something that people care about, but a big chunk of the market actually pays to be in that space. Like people were buying cars like Prius, and we know electric cars are really popular, and Tesla's done very well. So your goal then is to identify those companies that might not be well known, I presume, because they're smaller cap, but are doing two things. One, they're in the ESG space, but they're also showing they can make money out of it.
That's exactly what we're trying to look for, Peter, is companies that are doing a good job from a sustainability perspective. And what we're finding is that more and more companies are doing this for reasons of profitability as much as anything. And more and more companies are looking to invest in or take on renewable energy and use renewable energy, partially because it gives them a better power prices over a longer period of time. So they're going into longer term contracts with more stable prices, for want of a better description, and do that over time. So that creates opportunities for companies like Infigen, who are looking to sell to those sorts of companies. And that's what we're trying to do, is find companies which are leveraging that theme to generate good returns.
Are some of these companies also tapping into the government assistance to be those companies?
Well, that is one area, which means they often have a bit of a lower cost of capital for that reason. One company we have in the portfolio is called Genex. It's looking at building a hydro battery and a disused gold mine in northern Queensland, actually. And it has been able to secure government funding at good interest rates to help with that project and help get it off the ground. It's hopefully going to be at a financial close in the next few months. But that's an area where, for instance, they've been able to leverage that assistance and develop a really interesting project.
And it's interesting because not only are the companies that you might be selecting to have potential, because you analyse them on that basis, but there is like an artificial interest in supporting those companies, because a lot of the funds, the ethical investment funds, have done well purely because people want to be associated with ethical investments.
That certainly helps, and we find that more and more investors are looking to invest in an ethical way and with ESG friendly way. I think the latest stat was that over 60% of the funds in Australia actually look through an ESG lens. May not all be sustainable focused funds, but they do certainly take that into account.
How many companies will you have in the fund?
We've got around about 40 companies in the fund at the moment, so we're looking to have 35 to 45 companies in the fund at any one time.
Okay, this is a question a lot of my viewers would be interested in. Will there be a dividend, or it's more likely to be a capital gain play?
Often the companies, we do have companies in the fund which do have pay a dividend, but it is more likely to, we are more clearly focused on capital gains over the medium term with some of these companies.
Is this the right time for small caps? Because a lot of the big caps have done really well, and there's been talk about rotation into value fund managers and whatever. Would you put yourself in the value fund manager space?
Well, we look at things through a value lens is the way that I describe it. However, we're not looking purely at value companies for this fund. So we're looking at companies which we think that will have good medium-term prospects. We do look through a value lens, but it isn't simply value companies that we're looking at in this fund, because we are wanting to really focus on their ESG credentials and their sustainability credentials, where we think will deliver good growth over the medium term.
Okay, you mentioned Gen X and Infigen. Was there a surprise company? That's a hard question, but was there a surprise company that came out of nowhere when you were looking for them? You thought, gee, I didn't know much about this company, but it's got a real lot of potential?
Yeah, probably Kathmandu is a good example. I wasn't really thinking of it from this perspective.
No.
I always thought it through it as a retail stock. But I went to a couple of meetings with Kathmandu, and it became pretty clear that they have sustainability really at the core of what they're doing. Just the CEO last week was saying that they're really finding it a competitive advantage in their markets, firstly from a customer point of view, but also from an employee point of view, and getting employees really engaged and really going above and beyond to drive their business forward.
And so, Damien, for people who don't really understand exchange traded funds, and this one in particular, how can they invest in it?
Well, it's really quite simple, Peter. It's really like another stock on the ASX, so you can buy and sell the units in the fund on the ASX. And it's not like an LIC, so you can. There's a market maker who ensures that the stock trades around net asset value at all times. So it's not like an LIC, but you can invest quite simply on the ASX.
Great stuff. Thanks for joining us.